So it's time to get started. Well, thank you all for coming. Let me just pull up so I can see you all. Remember, if you've got any questions, do let me know. Brilliant. So everything's fine by the looks of it. Some really interesting moves overnight. I mean, there's not too much going on from an economic data perspective. There have been in the UK, but not from Europe, and very little out of the US. But that doesn't mean that there hasn't been some fantastic moves. Just looking at this here, this is dollar yen, an hourly chart. Look at that, continuing to get to that, very close to that 100 figure. Let's go back to the weekly chart to see our highs from here. We are looking at kind of 2009 highs, approaching some very key, obviously, resistance as we get to that 100. But it seems to me anyway like momentum is very much on the upside. Especially on the short-term indicators. Let's just take a quick look here. Yes, we've kind of run out of steam a little bit, but we think this is just a pullback that we're getting here. We did have a negative divergence earlier between what the hourly MACD and RSIs were doing and what price was doing. So a pullback is very, very natural and is actually going to be, we think, going to be used as a buying opportunity. I mean, looking here, obviously 98.90 was a big key resistance level yesterday. It's now support, and then below there, let's take a look at that, 98.20. That's a 55-hour moving average. I'm going to show you the 4-hour chart as well, because that's been yet again another one. It just suggests, yes, the closer we got to that 99 level, with the high today 99.68, we were starting to look very, very overbought in the very short term. So a pullback, very healthy at this stage, but we do think longer term momentum is very much, let's go to the daily chart for that. As you can see, longer term momentum is still on the upside, and 100 now is so temptingly close. Now, some people have said, well, where do we go above here? There were a few reasons why we saw dollar yen jump higher again this morning. It certainly wasn't on the back of economic data. Economic data in Japan was fairly weak, but it was largely to do with the government rhetoric. So Prime Minister Azo came out, a bit of confusion at the start, because what he basically said was that they're not worried about the sharp decline in the yen of recent days. However, that was lost in translation a little bit. So we did get some confusion earlier on, but right now the rhetoric is very, very supportive of further dollar yen gains. Now, what we have seen as well. What we have seen as well is, what we have seen as well has been, once you get a currency that's very sensitive to central bank action and to rhetoric coming out of the central bank, then it means that it's very sensitive to rhetoric going the other way. Now, we don't think they will go the other way, and remember that the reason why. Let's just take a look here. Just bear with me one moment. I'm going to pull up just another chart. This has been dollar yen's performance really since that Bank of Japan announcement last week. Look at it just rally, and partly some of the gains have been down to rhetoric, but it's mostly down to action. So in the past, yes, we think that the dollar yen is obviously it's reacting to rhetoric, especially to weak yen rhetoric. However, we actually think that. What we actually think is that it's not just going to be rhetoric that could not be. Even if a Japanese official came out and said, "Oh, hang on, the dollar yen is going too far too fast," we think it would take it would definitely take much more than that. Because the Bank of Japan have been so aggressive in what they're doing. Now, I'm going to show you kind of an interesting chart here, and just bear with me on this. Some people have said, well, how high can dollar yen go? I mean, obviously, 100 seems like it's a done deal right now. Above that, you've got to look at the whole numbers, right? You're looking at kind of 101.50 is kind of a resistance level from 2009 that we'll be looking at, or a support level from 2009, which is now resistance. And then we've also got 105 is another area that a lot of people are targeting for the end of this year now. Now, what I want to show you is, actually, I'm going to go back one more day, hang on. This is just like an intraday chart, so it goes all the way back to from the 3rd of April. So this is obviously when the Bank of Japan announced what they were doing, and then since then it's obviously continued to climb. But one thing that's really interesting, this shows you kind of the time over the days, and from kind of 0 till 8, that's like really the Asia session performance. And obviously what we've seen is Asia session performance on the day that the Bank of Japan announced their big stimulus. Nothing. We didn't see that dollar yen jump higher until Europe came in. Likewise, the next day, this was Friday, Japan didn't do it during Japanese hours, during Asian trading hours. There wasn't really much. And then look, Europe, US came and pushed it up. Yes, it was a bit different. Asia did get involved. Today, pushed it down. What did we do? European session started. We found a base. Now, what does that tell us? Well, it suggests, and we do know this from kind of CFTC data and positioning data, that actually the Japanese community haven't been as involved in selling the yen as places elsewhere have. So it's been mostly foreign hedge fund managers that have really piled into this trade and really helped make it move. Now, what does that mean? Well, basically, if this trend continues, then we think the Japanese community will get involved. And what does that mean for the retail trader? That means that there could be further to go on the upside in dollar yen. So essentially there's an important part of the yen trading community, the Japanese, who aren't necessarily, or the Asian community, who aren't necessarily involved in this move higher. If they do get involved, then that potentially means that we could see higher. And I know I agree completely. I know some of you are probably going there thinking you're crazy, what are you talking about? This is only 4 or 5 days worth of data, and I completely agree with that, but it is worth looking at. And I do think this is interesting, and I don't think it's just a coincidence. This certainly is kind of an important one. The other thing I want to show you, I'm going to construct a trade right now, a chart, sorry, not a trade. And it's actually to do with euro and what's going on with Japan. Right, so what this chart is, it's euro dollar, and it's the 30-year Japanese government bond yield, and it's just really interesting. I mean, this is euro is a white line on this chart, and the JGB 30-year government bond yield is the orange line, and the 30-year government bond yield has fallen very, very sharply, but recent days it's risen very sharply, and that does tend to happen when you've got kind of big depression or when you've got a big monetary stimulus program. You tend to see shorter term rates get pushed down and longer ones rise in expectation that they'll have to increase interest rates further down the line, right? They're definitely not doing it at the Bank of Japan at the moment, and they won't be for a while. So then, hence why people have been, apologies for that, hence why people have been kind of pushing it up further down the line. So what we've seen here, pretty much very, very similar time frame. We've seen the euro spike up just as Japanese government bond yields have. Added to that, we do know that the Bank of Japan is now going to be one of the biggest buyers. Is it probably very soon going to be the biggest buyer of Japanese government bonds? Now, what does that mean? Well, that means that holders of JGBs, and a lot of that is very domestically held. It's largely held by domestic pension funds and hedge funds, etc. in Japan. They're going to have to get out of the JGB market and go elsewhere, and we've already potentially seen a bit of that at the long end of this curve. And where have they been going? Well, they've been going into the euro. So partly, people have been saying, why is the euro rallying? What is going on here? The Japanese have deep pockets in markets, and basically what the Bank of Japan is doing, it's such a huge increase in its monetary base that it could have big repercussions on other markets. So do watch out for that. So basically what this chart shows you is that the yen and these 30-year yields, they are kind of moving together. Sorry, the euro and what longer-term Japanese government bond yields are doing are kind of moving in the same direction. Ahmed has just asked a great question. I'm going to look at that for you now. He's asked for the US, so those of you who've joined me before will know I look at this all the time, and I do show it to you. And it's the, daily, let's leave that there, and it's the government bond yield in the US and dollar yen. let's take a look at that here. As you can see, usually it moves in the same direction, right? So white line dollar yen, orange line is the 10-year government bond yield. That's not been the case right now. So we've seen 10-year government bond yields in the US actually come off quite sharply. Remember, we had some very weak economic data of those non-farm payrolls on Friday, very, very weak. It's now kind of reversed what's been going on it's now reversed kind of or led to some doubt about that early QE3 exit from the Federal Reserve. That's weighed on Treasury yields, so that's pushed them down. Again, they're kind of, around about that 175-ish mark, 1.75 mark. But yet, dollar yen has still been rising. Usually when that happens, when bond yields fall, we see dollar yen fall, as Ahmed, kind of probably was alluding to in his question. Why hasn't this happened? Now, we think the reason why it hasn't happened is because this is mainly a yen move. Now, I also want to just alter this chart slightly and actually do a bit of a spread between what's been going on with US and JGBs, the 10-year, and it just shows a little bit, oh, no, sorry, my fault. Let's just change that really quickly. It just shows you it's actually been moving much more in the same direction. So actually, Japanese bond yields have been declining alongside US bond yields. So that's another reason why dollar yen has been propped up. But what it goes to show is that yes, Treasury yields have been falling, and yet dollar yen has continued to be rising. Well, that's largely because it's a yen move, so it's yen weakness rather than kind of all dollar strength, and we can really see that. I know Pan has been asking for me to look at the dollar index, so let's just take a quick look. As you can see here, dollar index hasn't been going fantastically higher, even though dollar yen has made these kind of multi-year highs. It hasn't been a broad-based dollar move, and so really it goes to show dollar yen has been much more about what's been going on with the overall within the yen space rather than this. Now I realise I've just forgotten to do one quick thing. Just bear with me one moment. And what this is, I just need to show you guys my disclaimer really, really quickly. I just want to show you this now. Just to remind you guys that the information and opinions in this webinar, they're for general information use only, and they're not intended as an offer or solicitation with respect to the purchase or sale of any currency or CFD contract, and also all opinions and information contained in this report are subject to change without notice. Futures, options on futures, foreign exchange and other leverage products, they involve significant risks of loss and they're not suitable for all investors. And remember as well, increasing your leverage does increase your risk. Spot gold and silver contracts, they're not subject to regulation under the US Commodities Exchange Act. Contracts for difference are not available for US residents because of regulatory reasons. So apologies for that, but I just had to quickly remind you guys of that. So anyway, let's get back to this. And let's just take a look at that euro chart then. I'll go back to the dollar. In fact, this plays into the dollar, what's been going on with the dollar. But, I thought that chart of kind of longer dated JGB yields and the euro was quite interesting, and this is the daily chart. As you can see, really nice base here on euro, certainly a positive tone in the kind of short to medium term. Pan, I will answer your question shortly. Sylvester, if you just write me a quick note to say what GC, what that stands for. Gold, right, yeah, okay. Just bear with me one moment and I will talk about gold in a moment. But just going back to euro here, as you can see, we have moved higher. We've got across some really important levels. The bright green line on here is the 200-day SMA, simple moving average on the close, and we've even got above the exponential moving average here at kind of 130. We're around about testing it now, actually, around about 130.20. So some, significant moves. We've got above some significant resistance level here. That kind of 129-ish or 128.95 level, which is a simple move, 200-day simple moving average, is now massive support. And that's kind of the key level to watch. But as you can see, I'd say momentum, draw your attention to this bottom chart here, which is the daily MACD indicator, and suggests, obviously, we have seen this reversal Nice bottom in place there below kind of 128. On the more medium-term chart, on the shorter-term chart, this is an hourly chart again. We're at a 3.5-week high, 130.60. We have backed away from that level, but we still think that momentum on the upside for the short term. This is just a bit of a pullback. Good support seems to be 130.20 at this term, and I'm going to take a quick look as well at the 4-hourly chart, and as you can see on the 4-hourly, still moving higher really, even though we were starting to see just a bit of just starting to look a little bit over bought there, hence why I will just pull up my RSI. Just bear with me one moment. So yeah, starting to look a little bit overbought. So in the short term we're kind of meandering around a little bit, but I would draw your attention again back to this kind of daily chart level to suggest that momentum very much on the upside, certainly from there, and we're still moving higher in the RSI and the MACD. So it does suggest that potentially, above here, where could we go to next? Well, looking as we are, these highs here, around about kind of 131, is your initial resistance level. That was kind of it was a double top from early March, and then if you get above there, it's probably looking at 31.5. We're not necessarily particularly bullish from a fundamental standpoint. Whether or not we can get above this 131 level and even then above 131.50 will, I think, depend on position flows. And that's why I refer you back to that chart, the fact that, Japanese government bond yields are rising on the long end, which suggests Japanese investors coming out of their own bond market, and then we've seen in the past that they've actually held up. They've been a big prop for things like the euro in the past. They could be again, and the same way they could kind of still pile into treasury yields. So treasury yields have also fallen at the same time as dollar yen has been rising, and this could potentially be down to what the Bank of Japan is doing to the market, and it's forcing Japanese bondholders out of Japanese government bonds and into treasury. So maybe that could, Ahmed, this might be important to you, or worth you noting that relationship between treasury yields and dollar yen could potentially break down if that continues to happen. It's certainly something, I'm not saying it's happening now, but it's certainly something for us to watch. Pan has just asked, he was talking about dollar, how the longer term US economy reflects in the US index as generally expecting better economic data. Well, Pan, maybe not. There is a risk right now. Let me just I'll put back up the dollar index. I know we just saw it, but it's always good to talk about it. Yes, for most of this year we've seen much better than expected economic data, but then last week, remember, we saw a lot of economic data misses. The biggest miss, of course, being that payrolls number in the US. That was dreadful. 88,000, lowest level since June last year. It's significantly weak. I'm not saying 1 month makes a trend, but there is now fear that we're going to go into that summer slump, and that could weigh heavily on the dollar and how the dollar's performance relative to other currencies. So hence why we've not really been able to maintain gains above 83, and we've pretty much been moving sideways. Now, let me just draw this, because there is a bit of a triangle pattern going on, so we're not ruling out another push higher in the dollar, but we think it's largely going to be down to the economic data. A bit of a high there. So as you can see, we've really had a series of lower highs, which suggests that the broad-based dollar rally has not happened, and this level here is key resistance 82.50. It's a key support. Sorry, if we get below there, then I think it suggests kind of a further decline, a further weakening. And again, there are so many forces at work in the market. The bond market's obviously having a big impact. A lot of money in the bond markets. When investors make asset allocations like they maybe are doing in Japan, that can have big impact. And as we said, there's signs that Japanese investors are moving into the euro. I'll be interested to see kind of positioning data, whether or not we can shed any light on that in the next coming weeks. We'll certainly be keeping an eye on that. And that could be what weighs on dollar index. We've seen the dollar index come off, yet dollar yen rise, and that's because of strong performance elsewhere. I also want to show you the pound. I'm a bit more neutral on the pound, really. We're we've had some mixed economic data actually today, but by and large what we saw was some better production data. So industrial and manufacturing production data was stronger than expected, rose 0.8% and 1% respectively, and there was only expectation for like a 0.4% gain. Now, industrial data is still, it didn't reverse the January decline, but the market is very sensitive to industrial data because it has a very good correlation with GDP. So what we've seen is this better than expected industrial production report or industrial and manufacturing production report for February, which was released at 9:30 this morning, has managed to shrug off concerns actually about our exports. So we got a much weaker than expected trade balance, trade deficit, and what was worrying about that actually was that the trade deficit, our exports were actually lower to the rest of the world rather than the Eurozone. In fact, our exports to the US fell by 350 million, but this is not a good trend because really the Eurozone is so weak. If our exports, we need to rely on the rest of the world excluding the Eurozone. If our exports are falling out to the rest of the world alongside the Eurozone, that does not bode well for our trade deficit at all. Imports are stabilising, but it does show that trade will definitely be a drag on growth in Q1. I think a lot of people, when it comes down to the pound, especially cable, obviously being kind of the most traded pound cross, a lot of people are waiting for two key data releases, the 17th, which is the Bank of England minutes, and the 24th, which is the Q1 GDP, so that all-important Q1 GDP figure. There's a bit of uncertainty now about whether or not we're going to avoid a triple dip or not, and because of that, we think, that data is going to be really pounced upon. Obviously, that low, momentum still to the upside. We've managed to get above kind of 153 on the back of that industrial data, but we're still running into resistance here at 153.20. To take a look at it a bit on a shorter term level, we're not really in overbought territory yet after that sharp move higher, but we do think 153.20. And then potentially on the way up to kind of 153.50, these highs, very recent highs actually, could potentially thwart the bulls yet again. We think there's going to be kind of more of an incremental climb from now on, and we could actually be trading sideways. In the very short term, as I said, 150.50 on the downside, 153.50 on the upside. So, the pound has been, you could even argue as an incremental support, kind of 152.5 as well. So we could be just trading in a range, and that's where we see, I think the pound probably isn't going to be where the action is. It's going to be very much kind of a product of what's going on elsewhere. So that's kind of where we're looking there. I also want to show you the Aussie, and then I will go to gold, I promise, Sylvester. The reason why I want to look at Aussie now is because, we've got some important data coming up. Let me just extend this chart. There you go. Some important data coming up later this week, the employment report. We have some better than expected data coming out of China as well. So we've got some weaker inflation data, which could potentially reduce the chance of an interest rate hike in China. Remember, the Aussie is usually quite sensitive to policy changes in China, and obviously any sign that the government is trying to put the brakes on the economy can cause reverberations in Aussie markets. We're above this kind of key level, approaching the 105 level. We're currently trading at 104.50. We've had quite a nice bounce higher. Let's take a look at this in the hourly. Nice bounce higher so far today. 104.50 and then potentially 104.90 are the levels that we're going to be targeting. We've seen very good support here at 103.50. We haven't been able to break below there for quite a while. This suggests to us momentum is kind of on the upside. Again, to really get above there, we've got to get above this kind of 104, 80 to 90 level to have a chance again at 106. And in terms of where we may go from there, as long as support at this 103.50 level holds, we think there is kind of scope for more upside. As I said, that we've got this resistance level here at 104.97, and then let's go to the daily chart here. Then you're looking at these kind of 106 highs, and they are the highs from August last year, so they're very, very significant. We think the market will certainly respect them, but we think it is kind of worth watching out for. The other thing, another key driver of Aussie dollar has been Aussie yen's performance, and look at this. Aussie yen, this is a monthly chart, so it's going back a very long time, but this just shows you the kind of extended levels that we're at on the upside to in Aussie yen, kind of a 103.50, heading towards that 105 level, and this is the weekly chart. We're close to kind of levels we haven't seen since 2007 here now. Okay, gold. Let's take a look at gold. Gold was obviously a big winner from what was going on with the let's just take a look at the hourly chart. Gold a big winner after the very weaker than expected payrolls number, and that's because it weakened the dollar. Remember, when the dollar is lower, it boosts the dollar price of gold. So we saw gold rise on the back of dollar weakness. And that's kind of what's helped propped it up. This was all, this move here that you can see, that's all the post-payrolls move in gold. Interestingly, last week we really saw a sharp move lower in gold from the beginning of April. We were down $60. So a kind of recovery was expected, but since the recovery has stalled really, we haven't been able to get above 1580, which is now your near-term resistance level. But the downside does seem to be fairly well supported around about 1570. Right now we don't think there isn't too much, to kind of move it. Sylvester just asked, is there another move up? You know what? I'm never 100% sure with gold. I really don't think there is. I actually think there's more scope for downside, actually. I'm not a gold bug at all. And I think the fact that it hasn't managed to hold above 1580 is quite a key thing. I don't feel there's any directional indicators. Right now, inflation is still very low. And yes, while the Bank of Japan has been doing an awful lot of QE, that hasn't been the case in the US. And the US is still the biggest purveyors of QE, and they're kind of scaling back. So net-net, there's not actually been an increase or an expected increase in QE, because yes, the Bank of Japan has started doing it, but there is expectations that the Fed will scale back at some point this year. So I don't see that kind of reflationary concern really weighing on gold, helping to push up gold right now. In fact, if anything, I think the deflationary pressure, obviously in Japan, but also in Europe now as well, it's probably going to limit gold strength. I also think that gold, we possibly won't be able to move higher in gold. Our stock market's looking slightly vulnerable, like they're going to have a bit of a pullback. But as I said, in the near term, 1570. But then you have got very, very good support here, just below kind of 1550 as well. Just looking at that, we're getting close to kind of key significant levels. As you can see, this is the daily chart, so slightly longer. Sylvester, I know you're looking for another move up. I'm sorry to contradict you there, but we just have different views. I don't see that move higher. The fact it's stalled ahead of 1600 is worrying to me. However, if we were to get above 1580, then this would be your near-term resistance, 1615. It's significant. It goes back to February, and that would be the level of resistance that I would be looking at. This is where you may get some selling interest as well. Hopefully we've met somewhere in the middle there, Sylvester, maybe with our gold prices. So I just want to show you stocks as well quickly, and then I'll take a couple of questions. It's always worth looking at stocks here. As you can see, the S&P actually had quite a good day yesterday. Got back very close to those all-time record highs. Bounced nicely off that kind of sub 1550 level. That's attracted some buyers. Obviously, earnings season is what's key now. We had Alcoa, the aluminium producer, that kicked off things. Their earnings were better than expected. The one thing I would say about earnings and what could help support stocks in just the next few weeks is that the bar is very low, so expectations very, very low for US earnings season in Q1, so it could be quite easy to exceed them, and we do know that when you get earnings surprises, that can have a big impact on the market. So we may be propped up here, even if we do see some weakness in economic data. Again, the highs is this kind of level here, 1575, with the lows, of course, being 1532, the 50-day moving average, and then you're looking kind of sub 1500. A lot of people desperately want this pullback. However, during this earnings season, because the bar is so low, and it's easier for companies to actually beat these expectations, we could see just a bit of we could see quite a bit of support, and there may be no real need to push back. So there may be a pullback might be nice, but there may be no basis for it right now, not until we've digested earnings season. So that will really kind of come to its own in the next couple of weeks. Pam's just asked me to look at the Kiwi economy, please, and its effect on Kiwi, on Aussie Kiwi. Well, the Kiwi economy has been kind of mixed. It's had some fairly good data surprises prices. And actually, the RBNZ members have started to sound fairly cautious on inflation because of house prices. House prices have risen very strongly, what with the rebuild in Christchurch post the earthquake in 2011. And what we've seen is people actually start to just get a little bit concerned that the RBNZ are going to remain a bit more hawkish than expected, which is Kiwi positive. So we've seen a sharp move lower already in Aussie Kiwi, as you can see, but we are making a bit of a base ahead of 123, which is a significant level. I mean, again, the end goes back, that support level goes back to the end of February, but we do think that kind of gains will be thwarted in Aussie Kiwi around about this 123.90 level, just below 124 50-day moving average. I wouldn't probably look to extend shorts at the moment. I'd wait until we get the employment number. Now, the Aussie dollar is very sensitive to employment. That comes out later this week. In fact, I'll get the exact date for you. Just bear with me one moment and time, so that those of you who want it, who want to trade it, can see it. So we get employment on the 11th, so that is on, when is that? That is Thursday, and it's 2:30 a.m. London time, so it's pretty early. They're expecting 7,000, which comes after a very large increase in employment for February. So what we're seeing here, I do think that this cross could be fairly quiet, really, until we get that data. But one thing I would say is, let's look here. When it comes to the commodity prices, we've seen a sharp recovery in Euro Aussie on the back of kind of stronger gains in Euro dollar since the start of this month. However, we haven't really seen that in Kiwi, which has certainly helped support the Kiwi. It's been much more muted, and that's the reason why is because there's just less positioning in Euro Kiwi. So actually this Euro move has also had an impact on some of the commodity currencies because, people have got very bearish on Euro versus the Aussie. The minute the Euro dollar started changing and gaining, it caused a knock-on effect on Euro Aussie because there's less positioning in Euro Kiwi, had less of an impact. So Kiwi managed to remain fairly well supported. Again, just looking at kind of Euro Kiwi, the downside here, 151.5 is the support level that we'd have to breach. Would be a very bearish development for this pair and get us back to kind of 150. We do think it's potentially possible, and that's largely going to be on the back of relative interest rate expectations. Added to that as well, if we do see a bit of a hawkish RBNZ, this could attract flows from places like Japan as well, so do watch out for that. In terms of relative economic and monetary stances, we do think that the RBNZ, so the central bank in New Zealand, could potentially be slightly more hawkish than the RBA, which still sound a bit worried, a bit reactionary, whereas the RBNZ seem a bit more concerned about what's been going on at home, noticeably with that housing market, so do watch out for that. I'm happy to take one more question if someone has one. Dollar, will we see a pullback? In dollar yen? I guess I did say that I thought we would see a pullback in dollar yen. Let's just take a quick look here. There's been a pullback obviously in everything else, and it does look like it. 98.90 is kind of a key level, and it's holding for now. Below there, 97.70 is another key level, but we still think that medium term, or even in the next few days, momentum to the upside. And we say tantalizingly close to 100 now, psychological level. A lot of people are going to be expecting that. We could end up getting above there, but moving sideways just a little bit, just until we kind of evaluate some more economic data coming out of the US. Those initial jobless claims on Thursday, and then of course retail sales on Friday. So economic data is going to be key for the US dollars outlook and for dollar yen outlook in the rest of this week, certainly towards the end of this week. Sylvester, I've already looked at the dollar index, but I will look at it again. And as you can see, the pullback is happening already. With the dollar index, as I said, it gets below 82.50. That's a very bearish development. We're currently testing there now, which is this kind of a support line from here, and it opens the way to 81.70, which is the 50-day moving average. So I hope that helps. Thank you for joining. I'm sure that I know we went through a lot of ground here, so it's easy to get mixed up a little bit. But hopefully I managed to answer all of your questions. Thank you for joining, and please do join us tomorrow for more, next week for more. Thank you.